Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 28th edition of Market Outlook. And please be sure to sign up for this on our website. You'll be able to get it free every week, including the text version. So let's get into the overall market conditions, and we're going to cover the interest rate picture and look at different parts of the yield curve. And in addition, we'll take a look at Apple as well, including our normal fare. So first thing, spiders. Interesting, quite interesting action. Couple things to point out. We had what we call a glass ceiling pattern here, which was occurred right around the last time you had a similar type pattern, all in the key reversal category. However, we haven't really had much follow through. And what is that pattern? It's where you gap up to a new all-time or at least a 60 to 90-day high and close on the lows of the day. In this case, these are all-time highs for the S&P, something to be really cautious and cognizant of. In fact, it happened again the following day, where I think by one tick you gapped up to a new high and ended up closing in the bottom 25% of the trading range. Now, since then, you try to push down a little bit lower, but haven't been able to really follow through. So that pattern is still intact. The key number here to take out is that 170 number. That's a key number to take out. Until then, this potential topping pattern is still in play. Another thing to be cognizant of, we have interesting channel here. As you can see, this is the upper end of the channel. If we took a parallel, which is this line right here, and you can see when we breached it here, it broke down sharply, and at the same time came back through it, tested the highs, and now your key point to watch off of this key reversal pattern, or what we call that glass ceiling pattern, would be about the 167.50 level. So you can see on a closing basis, we have not been able to close beneath that level. So we're locked inside this trading range until we take out those highs. Also, on the market internals, Mcclellan Oscillator, you can see we got fairly overbought, crossed down under the what we call the demarcation line of going from overbought to a sell signal. Right, you can stay overbought for quite a period of time. So that's around that 150 level. And you can see that right now we're trading under it, so it certainly generated a sell signal right around when that key reversal pattern occurred as well. Excuse me, it's pretty dry out here in Santa Fe, New Mexico. Next, the thing is that as the market has the market internals have weakened, right? The Mcclellan Oscillator is a combination of up-down volume and advanced declines. And you can see it's been working its way lower, but we've really been going sideways so far. So yes, we're on a sell signal, key reversal pattern, but we really haven't confirmed it, as we've had trouble closing under that key day here, which was 3 days ago. I guess that was on Wednesday, right? Now, on a shorter term basis, we also have generated a sell signal as well. So you can see on advanced declines, we've moved through from an overbought situation to an actual sell signal, and up-down volume, similar scenario. So when you get those two combined, definitely cautionary. But again, the final arbiter is price. And the key number here right now is that 167.50 50 level or so. That that would definitely take out the closing and the opening prices back here. You can see I basically put this horizontal support line where the wicks of the candle sort of converge. It's sort of in this area. You can see that that's really your key area around 167.50, and the low on Friday. So Friday, you got a pretty good rejection of trying to get and work this market lower. So very mixed bag. Let's take a look at sentiment, right? You can see right here the VIX. We're trading under the 50-day moving, under the 50, under the 200. The 50 is above the 200, so the overall sentiment picture is not quite as positive as it was a couple of weeks ago. Nonetheless, the key picture here is that we're not overly frothy on the bullish sentiment, as we're basically trading within the Bollinger Bands. So that's a positive sign. So sentiment is good, not overly optimistic, but definitely well within its band here. So that overall, again, sentiment is definitely positive and not too frothy. All right, so we've covered the overall situation in the market indices. We looked at sentiment. We looked at some of the market internals. Let's take a look at interest rates. And we said we cover the full spectrum here. The key thing is, the most important factor here is this green line here on the monthly chart. You can see we're fighting to stick to the long-term uptrend, which is this 200-week moving average, right? So this 200-week moving average, you can see it's been sort of hanging on. We've been holding those lows that were put in a couple weeks ago right around that moving average. So that is holding. This is really the fairly long-term view of the market. If we break down under here, the last real vestige of support would be the 80 monthly moving average, and that's more around the 102.25 level. So if we can get through the, what level was that? Just going back. Yeah, if we get through the 107, 108 level, it looks like we've got another at least 4, 5, 6 points more before you're going to run into the ultimate long-term support. But for now, you can see that the channel line in the 20-year bonds is being attacked right here on the close on Friday. So this is where we've gotten this sort of waffling action. If we get through and break down beneath that 107 level or so, let's see exactly, yeah, excuse me, it's 10, a little bit above 106 here. That would definitely tell you that the topping pattern, potential topping pattern in the markets would play out. Meanwhile, the markets have been holding on, anticipating that this test here and a break of this trend line is going to occur. So how this plays out, you definitely want to watch this particular level in the TLTs, as well as a breakout above this trend line and the high of 1, 2, 3, 4, about 5 days ago. I guess the high of this last week. So those are your key points. The high of this week, 110, and the lows. These are really critical levels and are probably going to determine which way the market runs. But let's take a look at some other ends of the yield curve as well. Dollar sign IRX dot X. Okay, when looking at the overall interest rate picture, you really want to take a look and see not just one part of the yield curve. So today we're going to delve into, because the interest rate component here and what the Fed is going to do is so critical. Let's delve into the different parts of the yield curve. So IRX.X is the cash for the 13-week T-bills. And as you can see, we're trading under the 50-day moving average, really pretty much on the, from a yield standpoint, pretty close to the lows. So even though other parts of the yield curve are definitely, moving higher, nothing has happened on the real short end. So that is overall positive for rates staying relatively low. So that's one part of the picture. Let's take a look at another part of the yield curve. And we're going to take a look at, we took a look at the TLTs. Let's take a look at the TYX.X. And the TLTs that we looked at are the 20-year bonds. Here are the 30-year bonds. And you can see that this is the 50-day moving average. This is the actual yield, right? This is so it's sort of the reverse of the bond chart that we looked at, the TLTs. So this is telling you that as we're moving above this 50-day moving average, rates on the long side of the spectrum, the 30-year bonds, are actually at their highest levels since going back. Let's take a look here. Going back to 2011, right? Let's draw this line here. And I guess, so if you really think about it, this is where the big concern is, that where the Fed has the least amount of control of affecting rates, that the long part of the yield curve, right, the longer term part of the yield curve is definitely moving higher. And you can see that this this was the critical level going back to all the way back to 2011, right? And again, critical level, we want to get a little more precise. We really want to hold this 34 level in the TYX.X. This is again a cash index here. So we want to keep track of this critical level here in TradeStation. If you want to keep track of it yourself, $TYX.X is the way to track the very long end of the yield curve. So we covered T-bills, 13-week T-bills, 20-year bonds, 30-year bonds. So you can see the long end of the spectrum definitely under pressure. Rates are higher. Short end not really being affected yet. Let's take a look at another indication of interest rates. And these are junk bonds, right? And you can see that junk bonds trading right at the 50-day moving average. The 50-day is under the 200, so you were pretty much in a bearish phase. So obviously the attractiveness of junk bonds as rates go up in the in U.S. Treasuries are definitely going to be affected, and the junk bonds definitely still under pressure. So again, this is another negative for the overall interest rate picture in terms of, are they going to stay low or continue to move up? This is indicating more pressure on the overall interest rate picture. As we're trading under the 50-day moving average, you can see we had been really up for well over a year and a half. The 200-day moving average, we tested it back in late 2012, viciously bounced off, trend stayed intact, and again, under pressure, we've got this sharply declining 50 and a flat, but trading under, the market's trading under that 200-day moving average. And really, if we can get above the highs from a couple days ago, that would be a good sign that interest rates are abating. So remember, look at the junk bond. JNK is the symbol for additional indications of which way the interest rate picture is going to swing. Okay, so that pretty much covers most ends of the spectrum of rates. Did we miss anything else? No, I think we got. We can look at one other index. This is the total bond fund, and you can see tremendous pressure on the Vanguard total bond fund. This is a blend of lots of different parts of the yield curve. You can see we really broke down, came right up to the 200-day moving average, almost textbook case, declining 200, tested it, and we're now trading in a bearish phase. Definite pressure on a conglomerate of all different types of bonds and different parts of the yield curve here. So again, more of a negative in the overall bond picture. Now, I mentioned Apple. Some interesting things going on in Apple, and then that'll be it for today. What we see here is a potential head and shoulders bottom, and let's put in a trend line, a neckline here. Okay, so as you can see, shoulder, head, shoulder. What's most interesting is the action. You can see that the 50-day moving average flattening out and actually possibly turning up here. So this would be entering a recovery phase, right? If we can get above this trend line here, that would confirm the breakout after the earnings report. Now, from a fundamental or overall bigger picture perspective, I think it's interesting that the market reacted positively to the overall quarterly report here. And if we can get above this 50-day with conviction, take out the highs, it would coincide with this sort of neckline, this declining neckline here as well. Good volume on the breakout right after the earnings report, and a little digestion day. So look for it to hold this 50. If it doesn't hold the 50, sayonara. Probably, again, at least a test of the lows and a potential, who knows, we'll take a read back if we take out that 50-day moving average. But for now, I can see this head and shoulders pattern forming. If we can get, by the way, above this trend line, you're talking about a move from about 385 or so all the way up to the neckline of, well, let's call the neckline really about 460 or 470. So you're talking about a move potentially to the 525 to 540 level, which would certainly coincide with this level of resistance as well. So hopefully this is the end of the down move for Apple, and look forward to seeing this back in the limelight again. Always enjoyable to trade from the long side, and especially when you're talking about a leading U.S. company. So that's it for now, and see you next week. Hope you're having a great summer. And again, don't forget, sign up for this video newsletter and get it free every week. And you can just go to our website. Thanks, and bye for now.